1, 2, 3. Nailed it.
Nailed it.
Maddy, how are you doing?
I'm doing great, CJ. How are you today?
I'm doing well. Welcome back to the Financial Rundown. Before we jump into it, you got some sick kiddos at home.
Yes, it is the season, isn't it?
Cold snap.
Cold snap, yes. Yeah, so, I mean, not much to do other than take care of them and still make things happen.
It's that when the weather changes and it just seems like I seem to get the same sinus infection or something for the last 30 years, every year at like this time of year.
Yes, in fact, I actually went and I spoke to the doctor and she was like, you were in my office at this exact same time
the same
last
day.
year.
There you go.
Yeah.
Nice.
Yeah, and it's a tricky one this year. You know, they're talking that it lasts like up to 12 weeks before people really recover. So it's tricky, but
Yeah, just got to keep grinding through it. Drink your water, take your vitamins.
that's right.
See some sunshine.
Yeah.
There you go. So we're getting closer to year end here. It's 20 days away-ish. We're filming this December 8th. We're getting closer to year end. And so what are some year end dates and some things for clients to think about?
Yes. Well, I'm sure that there are many people thinking about Christmas. They're thinking about their list. They might be thinking about New Year's, maybe thinking about Boxing Day shopping. But you and
Shoveling their driveways.
I love shoveling my driveway.
Oh, well, you can shovel ours anytime as well.
I would
if you
love
want
to. But aside from that, you know, there are some really important dates in the financial world that we really need to make sure that we're keeping track of. And so December 31st is a really important date when it comes to making contributions to accounts like RESPs, or DSPs, RRIF accounts, or RSP conversions to RRIF if you're 71.
Yeah, that has to be done by the end of the year, and first home savings accounts as well. So first home savings accounts I think is a big one, to talk about because there's some more rules and restrictions around that one. So we want to get one open if you don't have one open and you're eligible to, so that you can build up that room. So even if you don't have the maximum $8,000 you can put in per year, you don't start accumulating that room until you open up the account. So you get an account open, get some money into it to start. You don't have to get that full $8,000, but we want to get it open so that you get that room and you have it available, so that you can use it in the future. If you wait till next year, you'll get your $8,000 next year, but not $8,000 for this year. So I think it's important to take a look at that.
Yeah, I think you're right. And then the other really, maybe it's a little bit of a niche market, but we think about the home buyers plan withdrawal from the RRSP account. So for the past few years, there has been a deferred repayment. So usually you have 2 years to repay your home buyers plan withdrawal back to your RSP.
Or you have 2 years until you have to start repaying it.
Right, so you have to start
gotcha.
repaying your first 1/15th, you're right.
Yep.
And so for the past few years, the government has added an additional 3 years of deferral before you have to restart your repayments, and that ends this year.
Gotcha.
So on December 31st, 2025, or I guess on January 1st, 2026, it will be back to that standard. You have to start your repayments 2 years after that withdrawal. So if you have a firm agreement of purchase in place, you might want to look at whether it makes sense for you to do that withdrawal sooner than later.
Take it out this year so that you would qualify for the delayed repayment.
That's right.
Smart. No, that's good. Yeah.
Yeah.
And RESPs are one of those things that you can get that $2,500 in per child by the end of the year. Now that does accumulate and you can backdate 1 year at a time. So, but if you do have those funds, 20% grant gets to work right away for you as well. And there's some things with the ages. You know, if your child's 14 to 17, you know, we want to be taking a look at that because there's some rules and restrictions around contributions and some things we can do there. So if you're in that bracket, make sure you reach out to us and let's do something before the end of the year.
Yeah, and in the spirit of holiday season and giving, really important to note about the charitable contributions. So charitable contributions to count towards your taxes for 2025 need to be in before December 31st, 2025. So if you're planning on making a charitable contribution, you want to use it towards your taxes this year, now's the time to do it.
one of my favorite things to do as a certified financial planner is review your income situation for 2025 before the end of the year. It may be worthwhile to redeem money if you're retired from an RSP or a RRIF. If your income was lower, we might be able to take out more than you might need and use those funds to top up your TFSA in the new year, add to your non-registered account, add to your bank account, whatever it may be. We want to always try to get out your money at the lowest tax rate. So there might be an opportunity to do that as well when we only have till the end of December to review that information and make a decision there or not. So that's an important one too.
Yeah, that is really important.
Our first topic is asset location, not to be confused with asset allocation.
Yeah. So asset allocation is ultimately how you decide to invest your money. So what types of assets do you decide to put it in when we're thinking of equities, bonds, real estate, GICs, if you're holding money in cash, that's really asset allocation. But what you're talking about is asset location.
Asset allocation gets a lot of the conversation, but asset location I think is just as important, if not more important, for long-term investors. Asset location is in which account should I own them to pay the least amount of tax. So if you're a client, there's some rules of thumb there, and one of them, for example, is that your stock allocation should be 100 minus your age. So if you're 30 years old, you should have 70% of your portfolio allocated to stocks. So an example of the asset allocation side of things. But the asset location, you could. That's fine. We could have 70% allocated to stocks, but where is that located? So you think of your different accounts, your retirement savings plan, tax-free savings account, non-registered investment account, locked-in account could be your first home savings account. So there's all these different types of accounts. It's our job to say which account should have the 70% stocks in it and which account. So overall, we can still achieve that general asset allocation, but not every account is going to have 70% allocated to stocks. I think that's where the asset location planning comes into play there. So for instance, your tax-free savings account, the textbooks would tell you to have your interest-bearing investments in the tax-free savings account because you're saving the tax on 100% taxable income. So you have a GIC that matures, the interest that you made is 100% taxable. If it's in a tax-free savings account, you're not paying any tax on that interest that you made. However, I would argue that if you're investing for the long term, and again, we're speaking generally here, but I would argue that your tax-free savings account should have your more growth-oriented investments in there to try to grow tax-free over the long term. So more capital gains focused stocks in that, as well as your non-registered account should have more of your capital gains focused investments for the long term to minimize your annual tax hit. And capital gains are taxed more favorably than interest income at the end of the day. When we're talking about asset location, it's certainly a bigger part of the investment plan than it gets credit for. So we want to be taking into account not only your allocation and your risk tolerance and those types of things, but which account we should be putting each different stock, bond, GIC, et cetera, into.
Yeah, and that's where we can really leverage that conquest planning tool that we use to really figure out what the taxes are and the tax implications of balances held in the individual accounts at different points throughout your retirement journey or sort of your life stage journey.
Don't underestimate the power of the asset location, and keep in mind asset allocation as well, but let's give it a little shout out to asset location there. Our next topic, concentration risk.
Tell me a little bit more about what concentration risk is, CJ.
Well, we have this nice little chart from, again, one of my favorite follows, Ryan Dietrich there. And when we look at the chart, what it shows is the top 10 stocks make up 40% of the U.S. stock market. And that is top heavy is what we keep hearing. We keep hearing how concentrated the U.S. stock market is and how the Mag 7 stocks are driving the market. And you know all about the Mag 7 stocks, so.
Yeah, so we're hearing that companies like Tesla, Meta,
I was going to quiz you. I was going to quiz you on
Apple,
the 7.
Google, Amazon,
You look down there. NVIDIA.
Okay.
We were so close. NVIDIA is the big one. Okay, but yes, and so they're driving the market, and what we hear from clients is just that top heaviness. So that's why when I saw this chart, it really struck me that I was a little bit surprised to see it, but also I think it's a good way to deliver, and why we're talking about it, to deliver to clients that in terms of the world scale, the global scale, it's not out of whack, for lack of a better term.
Yeah, and this is one of the things that I think that you are really good at, CJ, is when you see a headline, I think that a number of people can often get caught up in the headline, and then, they reshare it and they perpetrate a lot of the stuff that is in the headline. But CJ here, you really like to go and fact check that and say, like, is it really statistically significant? How different is it from the rest of the world? Does this really matter? Do we care about this? So you're really good at that.
Thank you. I appreciate you saying that. And yeah, certainly it's one of those things where you see the headlines a lot, and it makes me want to dive in deeper, because I know that, we're all bombarded and looking at that. But at the end of the day, trying to always drill down to what does it mean for clients, and what does it mean for their investments and money at the end of the day there. So some of those headlines are that the S&P 500 is dangerously concentrated right now, whereas the average, looking at the chart there, the average top weight is 67%.
6-7.
And the U.S. is third last at only 38%, which is literally one of the most diversified major single country markets in the world. So again, it's maybe not as bad as the headlines would make it out to be. And I think this is where I want to pivot and talk more about the Canadian market, which is on there at 43% in the chart there. So again, not one of the more diversified and less concentrated country markets out there. But in terms of pulling it back to clients' investments and their portfolios, we work hard not to be overweight Canada. And Canadian market has done very well this year. The TSX has done extraordinary this year, despite bad news headlines here. But in terms of long-term global markets, the Canadian market makes up about 2 to 3% of the global markets, and so with the S&P 500, US is about 60% of that. So, getting exposure to these bigger companies and the companies in the US that are very global. When you think about some of the ones that you named there, we all renew our Microsoft Office 365. I'm sure lots of people have Amazon packages being dropped off, et cetera, Apple phones and all that. So they're very global stocks, very global companies there. So it might not be the risk of investing in US large caps. It might be the risk of being overweight Canada in terms of that global scale.
Yeah, I think Canada has the same bias, right? Where the top 8 or top 10 companies listed on the TSX are not very well diversified. When you have the 6 banks, you have Shopify, CN Rail,
and then oil,
and oil, and so we are not well diversified here either. But if we zoom out the lens a little bit and think about really diversifying across countries and geographical areas, I think that's where you can really get the better diversification and worry a little bit less about the Mag 7.
Yes.
So the bottom line is that adding US large cap actually reduces your concentration risk in Canada. And in fact, maybe the biggest risk of all isn't owning too much NVIDIA, but it's owning too much Canadian stock and thinking that you're well diversified.
This is where our investment in the Y-Charts platform research tool really, I think, sets us apart from other advisor teams and other wealth management teams, because we are looking at that for clients, and we're looking at their region exposure, we're looking at their asset allocation to a detailed level, and being able to monitor that. So it's one of those things that we review with clients during every meeting, and if you're interested in diving deeper into that, then please reach out to us. We're going to do a new transition. A nice transition, like
All right, let's
like
talk.
Scooby-Doo transition.
Okay, so in RRIF news, there had been discussion about decreasing the RRIF minimum payment required down by 25%, but alas, the federal budget was released and there was no mention of reducing the RRIF minimum payment.
And certainly would have been nice to get that news earlier in the year so we could do some appropriate planning with clients. And now we're at the end of the year, so we've had to kind of fly blind when it comes to that. So working with clients to make the plans, not knowing whether this was going to be or not be. I don't think it makes as much of a difference for this year, but why don't we give the people a quick RRIF refresher?
Yeah. So before we talk about RRIFs, let's talk about RRSP, so Registered Retirement Savings Plans. So that's the account that you use to contribute to and defer taxes while you are working. So it's a registered retirement savings plan. Mm-hmm. Then you must convert your savings plan to a registered retirement income fund or a RRIF, and you must do so. You can do it anytime ultimately, but you must do it by December 31st in the year in which you turn 71, and you must take your first payment when you are 72. And so right now that minimum payment has been standing at 5.28%. So what does that look like? So whatever your account balance was on December 31st in the year in which you turn 71, when you are 72, you have to take out 5.28% of that account balance.
So if you had $1 million in your RSP and it converted to a RRIF account, that 5.28% would be $52,800 would be taxable income for you in that year.
Right. And so I guess what is the advantage, CJ, of decreasing the RRIF minimum payment?
I think why the government was talking about it was to give retirees some more flexibility. So we saw during COVID when the market dropped very quickly that they did give a bit of a reprieve for retirees in that year where they weren't forced to take out that minimum amount. And the reason for that is that when the market's down, we never want to sell low. So if you're forced to take out a minimum amount from your RRIF, you're forced to sell something out of your RRIF and take that money out. So it gave retirees a bit of a reprieve that they didn't have to sell anything to take it out during COVID in that time. So I think if the advantage of reducing that RRIF minimum, as they were talking about and now have deleted from the budget or whatnot, the advantage would be that it would be easier for retirees to manage their taxable income in retirement. So if you're not mandated to take that 5.28% out, then you may qualify for more OAS. It's easier to manage those types of government benefits and that. Whereas if you are mandated to take that amount out, it can increase your taxable income, and therefore maybe you get OAS clawback. You don't qualify for as many credits or medical credits and things like that. So that's one of the reasons I think that they were talking about that, is to give retirees some more flexibility and make it easier to manage their taxable income in retirement.
Right. So talk to me a little bit about what the risk is of actually decreasing the minimum RRIF payment and why they wouldn't do that.
So I think it's one of those things, one of those political things that, if you're the government in power, you have an idea when you're doing your budget and forecasting, you have an idea of the balances that are in these RRIF accounts. So you get a feel you could project out what amount of tax you're likely to collect, knowing what amounts need to come out of those RRIF accounts nationwide. So I think the risk is that it would create some uncertainty in terms of the taxes that you're going to collect in the short term. You would still collect taxes in the long term, but governments that are in power now tend not to really care about governments that are potentially going to be in power in the future. So I think that's one of the reasons why is that right now, with those minimums in place, it creates some certainty as to future tax revenues for those governments.
Right. And there's, I think, risks to the individual as well in terms of reducing those minimum payments and deferring them forever. Talk to me about that. Yeah,
that's a good point.
So I think that the risk there is if you have saved a lot of money, and we talked about this in our story that we covered a couple months ago there. But if you leave your balances in a RRIF account, you might benefit first from the spousal rollover if you happen to expire and you had a surviving spouse.
Expire.
But should that,
I like the way you put that. Expire.
should either yourself, if you didn't have a spouse, or your
Widowed or yeah.
and if they expired, then that is a full withdrawal taxable in the year that the balance has been taken out, right, to distribute to your beneficiaries. Now, you've expired, maybe you don't really care, but your beneficiaries might. And
it's always about keeping more money in your pocket, in your family's pocket, or in your legacy's pocket than in the government's for most clients there.
Right, and actually to that point, I think when you and I spent a lot of time in Conquest Plan, and we talk a lot about the estate planning piece and the legacy and keeping money there for your beneficiaries if that's one of your priorities, right? And a lot of times it doesn't necessarily make sense to only rely on the minimum payments from your RRIF account, and it might be worthwhile to move some of that money out in a lower income tax bracket a little bit sooner, or pay that tax a little bit sooner.
At a lower rate.
At a lower rate.
To save a bigger tax bill at the end. So Jerry always said that he thought that down the road that they would eliminate the minimums altogether, and that would potentially create more tax revenues for them, to your point on collecting at a higher tax rate when people die. But not that I've heard that they're talking about that or not, but Canada, to his point, Canada is one of the only countries that forces retirees to withdraw at a minimum rate. Most have the flexibility to take out as you see fit and as needed. So an interesting thought that Jerry's had for years and always talking about. I don't think we're quite there, but it's something to consider for the future. So our new segment, the client question of the week. So our client question of the week, let's go over to our caller.
Hi, I just wanted to ask, given the outlook for the US dollar, what changes do you think I should be making to my portfolio right now? Thanks.
That is a great question. First, I think what we need to do is figure out what is the actual US dollar outlook. And so I have this chart here, which is the foreign exchange outlook for the US dollar relative to other currencies. And you can see that over the next couple of years, it's forecasted to go down. So why is the US dollar being devalued? So generally, the US dollar is being devalued right now because Trump's mission is really to bring things home, and in order to bring things home, they need people and other countries to want to buy their products. And by devaluing the US dollar, it makes it cheaper for other countries to purchase the goods that are produced in the US, which then increases exports, which contributes to Trump's mission and what he's trying to achieve.
Yep.
And so when we think about what are some things or some ways that the US dollar currency, or all currencies really, can move our central banks and interest rates.
Which is why Trump has been on Jerome Powell's back about getting rates down in the States.
Yes. And then the other thing that influences currencies to move is the global mood of investors and how they are feeling about that. So
which is good. I think that's a good start to it. So if the outlook is down, and now we know a little bit more about why the reasons that the currency moves, but I wanted to look at an example for our clients and their investments specifically. So further to that question, if we think that it's going to go down, let's look at this example on this chart here. So in the chart, you can see, what happens from the start of the year if you had invested $100,000 in a U.S. equity mutual fund. So you have Canadian dollars and you're buying U.S. stocks. So on January 1st, we have what happens in the fund. We have the conversion rate, and then the value of your U.S. stocks, and the value back in Canadian dollars, and then what you see on your statement. So if we look at January 1st, let's say the client invests $100,000 Canadian, and the exchange rate is 1.38. That's $72,400 of U.S. dollars worth of maybe Apple and Microsoft shares, just as an example, and that's $100,000 Canadian. So you start at that $100,000 Canadian. If we fast forward to March 31st, let's say US stocks rise 5%. It was a great quarter. And the USD to Canadian dollar goes from 1.38 to 1.36. Well, that means that you have your US stocks are worth $76,087 in US dollars. And in Canadian, that's 103,478. So 3.48% increase. Your stocks helped. They were plus 5%, but the Canadian dollar strengthened a bit, so you have a small currency drag there. And if we fast forward to June 30th, let's say the US stocks were flat from March, and that currency went from 1.36 to 1.34, you're still 76,087 US dollars, but your actual value and what you see on your statement, $101,956 Canadian. So even though the US market was flat, you have a pure currency loss there. Now, if we went to December 1st, 2025, let's say US stocks were up another 8% from January 1st overall, 1.34 to 1.4 on the currency exchange there. So your US stocks are worth 78,261 in US dollars, and they're worth $109,565 in Canadian. So you're up 9.57% year to date. Stocks did 8%, but the weaker US dollar gave an extra boost to get you up to that 9.57% year to date. So overall, the US stocks can go up, down, or sideways, but the Canadian value of your fund can still move in the opposite direction purely based on that currency.
So my thoughts on it are, when risk is on, commodity and oils are high, the Canadian dollar is going up, and that gives us a tailwind for investments, US dollar investments.
For US dollar investments, yes. And when risk is off and there's fear and recession, investors tend to run to that US dollar. So that provides a little bit of protection on the downside for Canadian investors that are investing in US stocks.
When we zoom out the lens and we think about longer term implications, generally these trends and these cycles tend to cancel each other out. And so generally speaking, we don't like to play in those waters.
We're on the recommendation
yes.
side. What are you thinking?
Yeah.
What do you got for us?
So holiday season's coming up. Anytime we're coming into any sort of season with lots of pressure, I like to really take a moment, take a deep breath, and really think about setting some good intentions and being mindful about how, where, and when we spend our energy, and making sure that it fills our cup. What about you?
Yeah, I feel like this is one that I usually harp on a lot, but just with Christmas time and it's an opportunity to get together with family and friends, and how those times go by quickly, and just how it's nice with all the negative headlines we get, and how easy it is to get bogged down in bad news and doom scrolling and all that BS stuff. It's nice to get out and socialize and be with friends and family and have a good time, and realize that the world's a pretty good place when you're surrounded by good people. So
yeah, I'll see you out on the toboggan hill.
See you out there.
Okay.